In this video, traders, I'm going to talk about my first decent trading strategy. Stay tuned. Hey guys, warm welcome to you. Alright, so I want to talk about my first decent trading strategy. Make sure you are subscribed if you're not already, because I'm going to talk about a kind of few failures I had before I kind of what I class as a decent strategy that really had some longevity to it and kind of got me going and got me rolling. So this was a question from US Citizen. That was the name. Appreciate that. Thanks, US Citizen. Appreciate your comment, your question, and any of you guys who have sent in your questions or comments or any kind of comment. Just appreciate your support. All right, guys. So this was a great question. What was your first kind of thing that you got going with? So I want to talk about one specifically that sticks in my mind. When I was trading, when I started off trading after a few months. In fact, it might have almost been a kind of year or maybe 2 years. Basically, the UK was quite far behind the US in terms of getting access to the market, and there was a new broker out there that basically said, okay, there's a reasonable barrier to entry. I mean, it was quite expensive to get an account, but you were allowed to then trade directly in the exchange, the London Stock Exchange. You're allowed to trade directly in the order book, which is kind of quite a new thing. And they had a relatively new as well order book style called sets, and this is moving away from the market maker model, which was CQ, and I've done a kind of brief video about this before, but now it allowed you as an institution to put in your orders directly without going through a market maker. Now this broker said, hey, okay, we'll allow you to put your orders in directly. There's a qualification criteria. We'll execute them as a trade at our end. We'll wrap it up as a CFD, deliver it to you as a CFD, and you can trade it on margin. And it was great. And a lot of traders like us kind of have moved over into that from perhaps traditional stocks, from perhaps spread betting, which was just kind of getting going, was super expensive spreads, into this. And it was great. Commissions were high, but nevertheless. So the point is now you can interact directly into the market as a kind of retail trader with some experience. So at that moment in time, the FTSE mining companies in the FTSE, I was trading the FTSE, London Stock Exchange traded stuff, FTSE 100 stuff, FTSE 250, that kind of thing. The miners were moving massively, and I remember at the time, back then we had Xstrata, we had BHB Billiton, we had RioTinto, and we had Anglo American. Now, the landscape has changed dramatically since then. There's been a lot of mergers, there's been a lot of takeovers, there's been a lot of all sorts of stuff, so this won't be the same, but I remember it. I'm just pulling it out of the back of that brain because I remember it very, very vividly. So they would be moving very aggressively, and very often a lot of these would move in sync. So what I would do is I would look at these main ones. I would pick 3 which were moving the most in sync, and that was just because there was actually, if I'm honest with you guys, as a combination of screen space for me at the time, just having like one chart per screen, having these massive CRT monitors plonked on my desk, and it was a case of, well, one of them would kind of be a laggard, and I also thought, well, I could get most of what I need from just tracking 3. I didn't want too much noise. So I plot my 3 charts up like this, and I'd have the 3 mining companies there, and they'd kind of all move in sync like this. You know, they'd move along and they'd all move together. And that was just the volatility at the time in the mining sector. So I'd be watching those, and then I'd look at what I was wanting to trade, which is what I called the second tier miners. Now you had stuff like Kaz, which was Kazakmies, can't remember how you pronounced it. What was the other one that was on there? Can't remember off the top of my head. The point was, there was a couple of other second tier miners that you could play based off of the first tier miners moves. Let's just call it ABC for now. I bet I'll remember it halfway through the video. But the point is that these were like the primary signal. Okay, this is a pretty simple strategy, but it's worked for so long. I don't know why, and we'll talk about at the end of the video how I think you could replicate that now. So these would be sitting there, and I'd be monitoring these, and I'd be trading perhaps one of these smaller miners. Let's just use Kaz for now. So that would be in my order book here, and I'd have my level 2, and I'd have all the bids and offers stacked up like this. So let's say, for example, I saw my 3 that I was watching starting to dive off a cliff intraday, and okay, dive would be very nice if it did happen, but let's just say they were ticking down steadily, selling pressure coming in across the miners. Very often, this chart here, draw that correctly, would just still be sitting in a range. So they would all start to dip off, and that would still sit there. Sounds too good to be true, but this is what was happening. So the thing is, you couldn't trade these like via a spread bet generally because the spread was often quite wide, because these were lower tier or second tier, I like to call them miners, lower market cap, not so much institutional interest, the spread would be quite wide on them. So it became quite tricky, because even if you started hitting the bid with the spread and everything, by the time you kind of got your profit out of it, it was tricky to do. But what you could do, the fact that you could trade with level 2 meant that you could put your order in. Let's say we saw the miners coming down, I wanted to go short on this, I can start to put my order in here on the best offer, or even kind of quite aggressively a few points down, get filled on that, or get a majority of it filled, and then eventually this would kind of cascade lower a little bit later to the party, or at least offers would start stacking down and it would start filling that spread up. Then maybe, you know, it wouldn't take much for it to kind of move and to give me a profit, if that made sense. It didn't have to need to capitulate through the floor, because it was relatively thin as well. It didn't need that much trade to take place. It needs people to get a little bit more aggressive on the sell side and hop in front of me after I traded it, and then maybe take out a few order levels, and before you knew it, you had like a decent amount of move. And then you'd watch for these to kind of stagnate or start to curl back up, and then you put your bid in here and you try and get filled on the way out, so you just snatch that. So that worked really, really well for a long time. And in theory, it was like, okay, these are the ones that institutions are moving. These are the second tiers. These are just kind of following what the big players are doing. And so I'll just trade these smaller guys, because I'm a little fish in a big pond. I'll just trade these smaller guys. And really thinking about it, the whole edge of it really was the fact that institutions couldn't be bothered with it, because these were so relatively thin, these second tiers. And you know, being relatively new, having the ability to do that and put your level 2, your order straight in the order book, meant that there was a little bit of an edge there as well. So it was a kind of combination. This is the kind of things that happen, and I'll talk about these in future videos, guys, about other edges that came with other markets, like crude oil, like DAX and stuff like that. So it was really looking at primary markets and then trading the secondary. To replicate that now, how would I do it? I wouldn't do it on the big exchanges, because I think that, you know, there was a perfect storm of technology, of this and that and the other, like I just explained. So I wouldn't look for it on the big exchanges. However, you might be able to do it on maybe smaller exchanges. You also could do it perhaps on the big exchanges if you go to like 4th tier, if that makes sense. So let's say you've got your primary sector here, then you've got secondary, and you're kind of 3rd or 4th level down, smaller market cap that might move based on the whole sector. Now you need a sector that's quite volatile, a sector that moves in unison. Let's say it's retail, let's say it's pharmaceuticals, let's say it's something that's quite in vogue, oil and gas, and you know that everything's moving based on the sentiment of that sector as opposed to individual news coming out. Perhaps on pharmaceuticals, it's all individual, biotech's individual kind of achievements of the company. So you'd find that, and then you go several layers down, so that you were a small fish in a smaller pond that was moving based on the ripples in the big pond, if that makes sense. So you'd wait for those ripples to move, and then you find those opportunities in the smaller ones, and then potentially look for those moves. Direct market access, I feel, is a must, because as I say, the spreads were generally wide, and they would be generally wide on that, so you couldn't really spread better, you couldn't really do it. You've got to kind of work some orders in the order book and the pros and cons that go with that. You look to work it, look to move, push it down. Limitations of that: trading size. It's, you know, you might not be able to get enough size off, because you're going to have to be able to take what you can get. You stick in the order book, you might just get, you know, a quarter of what you want, or a tenth of what you want, even sometimes. Sometimes you get the lot, but you couldn't predictably scale it up, if that makes sense. Like you were trading Apple, for example, and you can trade whatever size you want. This was very restrictive in terms of there was a distinct cap on size. So it's not something that you could leverage on forever as you grow, but it's potentially something that's there. To be honest with you, I've not investigated this any further from a while back there, just purely because there's loads of other things. I think there are better opportunities out there. But that really was the first decent trading strategy out there, and it was looking at the first tier of the top sector of the miners and trading the second tier under. As they started to move, the first tier, jump on the second tier, assuming that that was going to affect the movement of the second tier. And there was often enough of a delay to get on it. And like I say, the edge of this spread as well on direct access helped make it quite a nice trading strategy. Take care, guys. See you in the next one. Bye-bye.